Welcome to your market brief for the week of May 4th. Call it a tale of two markets. On one hand, April was the best month for stocks in over 30 years. Yet, job losses have topped 30 million over the last 6 weeks. Now, as several U.S. states continue to take steps toward reopening, should investors employ an old strategy of selling in May and going away? My next guest says no, absolutely not. Sam Stovall is Chief Investment Strategist with CFRA Research, and he recently offered his take on how to maneuver these challenging markets. Watch this.
I actually advise investors never to retreat, meaning go away, but actually to rotate, stick with stocks. But typically in the May through October 6-month period, the defensive consumer staples and healthcare stocks tend to outperform the market by a more than 2-to-1 margin, and the frequency of outperformance is pretty impressive.
Do you think we're out of the woods? I mean, there's this big question now as economies across the country are starting to reopen. At least some cities are seeing coronavirus cases peak, or at least that's the hope. There's rising hope for a treatment as well. And then of course in April we saw the best month for stocks in decades. So does that mean that bear market is over and we're in the clear?
Well, March 23rd certainly was a pretty sharp low. We eclipsed the 20% decline threshold in only 22 calendar days, which was twice as fast as the second fastest, which was in 1987. And if March 23rd is indeed the low for this 34% bear market, it ended up being 3 times as quick as the 1987 crash. I think that don't get misguided by April, because April historically is the best month of the year in terms of average price change, and the second best in terms of frequency of a positive month. So it could be that because we had the negative news overwhelming investors, that we needed at least a rally, a reflex rally. But at the same time, because of all of the massive fiscal and monetary stimulus, I think that if we do get a retest, it will likely not go below the March 23rd low.
My thanks to Sam Stovall. Now let's take a look at the week ahead, starting with the economic calendar. On Wednesday, we'll get the ADP National Employment Report. That's followed by the latest in weekly unemployment insurance claim data on Thursday. And then on Friday, the BLS releases the jobs report for April, where the unemployment rate is expected to surge from 4.4% to over 15%. On the earnings front, major companies reporting include Activision, Disney, DuPont, and EA on Tuesday. Then we'll get CVS Health, GM, PayPal on Wednesday, followed by Hess, Hilton, and Viacom CBS on Thursday, and then Broadridge and Noble on Friday. Keep an eye on Disney. Analysts will be awaiting additional guidance on the reopening of theme parks from Shanghai to Orlando and how social distancing measures will be implemented. Turning to airlines, Warren Buffett made quite a bit of news over the weekend during Berkshire Hathaway's first virtual annual meeting. I checked in with Al Root, Barron's senior writer, for his reaction to the biggest headline. Watch this.
The most surprising thing from this weekend was the revelation that Warren Buffett has exited the entire stake in airlines. Berkshire Hathaway owned between 8 and 10% of all 4 major carriers. So if you look back to the financial crisis in 08 and 09, Berkshire Hathaway was putting cash to work, buying stakes in depressed companies. Fast forward to today, Berkshire seems to be throwing up the white flag saying, I cannot deal with this level of uncertainty. That is something that's very different. So it'll be a splash of cold water in the face to airline investors. But the value destruction is very real and has already happened. Travelers going through TSA checkpoints down 95%. 2/3 of the global commercial jet fleet parked. Boeing stock down 60%. So the revelation, while surprising, might actually lead to a little bit of a relief rally. He was a huge owner, and liquidating a stake like that is a massive undertaking. Now, whether these stocks work into the long term is, of course, up to the virus and then how we behave after we are allowed to leave our houses again.
My thanks to Al Root. Shifting focus now from airlines to energy, Katie Nixon serves as Chief Investment Officer for Northern Trust Wealth Management, where she's responsible for overseeing nearly $277 billion in assets under management. Katie, great to have you with us.
Thanks for having me.
All right, so let's talk about energy prices. Oil prices saw a sudden and steep decline recently. They're continuing that decline today. What's your outlook there, and are there opportunities there?
Well, we have here just a classic supply demand imbalance. I think the supply, as we're getting the numbers in from April, was just off the charts in the face of a real demand shock driven by the COVID-19 mitigation measures around the world. That's going to take a while to balance out again. We're having some supply reductions from OPEC plus. We've got some well shut-ins here in the U.S. That's going to take a bit of time to work its way through the system. So we would expect weak oil prices to persist until we have more clarity on the contours of the economic recovery going forward.
In terms of the broader market, shorter term, do you think the stock market got a bit ahead of itself? And longer term, what sort of recovery is priced in, and how does that compare to your outlook, Katie?
Yeah, I mean, I think it's in phases, honestly. So we're past the first phase, which is sort of the shock and then the awe, the shock of the demand shock and the awe of the policy response. The monetary policy and fiscal policy came in really quickly here to kind of cut the left tail off, if you will, to take that really negative outlook off the table. People were worried in March about a depression. So policy has effectively taken that off the table to leave us with the second phase, which is going to be what's going to happen with fundamentals. So I think the relief rally is certainly in the rearview mirror, and gains going forward are going to have to be driven by the fundamental outlook because, to your point earlier, where we are in the market from a valuation perspective looks a little bit expensive relative to history. We're selling at about 17 times next year's earnings. So that takes out the trough that we're going to have in 2020. And looking at history, that looks a bit high. Now, it's not that it can't be sustained in an environment of sustained very low interest rates, and we certainly expect that the Fed's going to stay low for long, and that global rates will stay low for a really long time. So that can support multiples and valuations, but to move forward, the market's going to have to see clarity on fundamentals.
Futures are pointing to a lower open today, although anything could change, as we know. But would you look then as an opportunity of a down day to be a buying opportunity? Do you hold pat? Do you keep it in cash? What do you do?
Yes, so we've told our clients to stick to their plans. And so for many clients in March and in early April, their portfolios had gotten out of whack. Because of the sell-off, they were underweighted in equity, so we were recommending rebalancing. Right now, we're just saying stick to your plan. Try to look past this near-term volatility, because one of the things we are confident in the next couple of months is the market's going to stay pretty volatile as we all start to work our way through what the next phase of the economy and of the market will look like.
Katie Nixon, Chief Investment Officer for Northern Trust Wealth Management. Really appreciate you joining us. Thanks so much.
Thank you.
That concludes today's market brief. Stay safe and take care of yourself. I'm Caroline Woods. Thanks so much for watching.